Market Minute for Wednesday, August 12th. I'm looking at the futures gap chart of the S&P 500. So this is the futures daily chart of the S&P, the ES, but I'm only looking at the trading that occurs from 9:30 to 4 o'clock Eastern Time. And one of the things that I talked about the other day was that this market does not allow gaps. We have not seen a daily gap survive for over 6 months now. In fact, this one down here in early February was the last one that we have seen. So what happened was we had this big gap on Monday. Okay, so that was Monday here, big gap, and that's the thing that I talked about, saying, hey, this gap is not going to exist. And look at this, we closed it already yesterday. Now this morning what's going on is that we've got a gap down here, right? So we gap lower and we're down here. So this is the current gap, but chances are pretty good that we're going to see this closed as well too shortly. So that's the story about the market from the gaps. Now let's pull back and look at some other things. So here's the 24-hour chart of the S&P futures, and I'm going to redraw this slightly here. This is the triangle pattern that the price has been inside now for the last few weeks, really since the beginning of July, the first week in July or so. And today there's about 3 hours left to the cash market trading, and so far we're breaking heavily down below that level, below the lower trend line. However, what really counts, and this is one of the few times that I look at the closing value of a candlestick, but what really counts is where we close on this. So yeah, this is great that we have lower lows showing up on the S&P, but if the price closes back inside of this triangle, it is going to provide a massive short squeeze. There's going to be so many people that jumped on board this move out of the pattern and went short that if any institutional buying starts on this dip, then all of that short interest needs to be squeezed out, and this is what causes some big moves to the upside. Now conversely, if again, in the next 3 hours, if it's not able to close back up inside of there, then this is a fairly significant drop. And this is the S&P. Actually, the other indices are a lot weaker than this. Here is the Dow, and actually the Dow is starting to approach. We were starting to get very, very close to that 10% correction level. So just eyeballing this, it looks like we're down maybe about 6%, 6% plus out of that 10%, so we're getting there, and we're starting to see those weekly lower highs and lower lows and trading within a broadening pattern, which is a channel to the downside. We're also seeing a death cross here of the 50 and the 200. So none of these are particularly good signs. Now, what we might be seeing, again, let's pull out the weekly chart here so we can see a little bit different perspective on things. Because what I'm seeing is potentially fractal patterns within patterns. Now, this goes back, I talked about this a few weeks ago, but if you look at this pattern up here, this is a very small little head and shoulders pattern. And actually it looks like we've already just about hit that target to the downside. All right, very small. You kind of have to squint and stand on your head to see it correctly. But if you look at this now, let's clean that up. What's now starting to manifest itself is a larger head and shoulders pattern. We're almost down to this neckline here at about 17,000. Now we can more clearly see the left shoulder, the head pattern, which looks like it's coming down and sort of finishing now. And we might see a right shoulder build from here. So we'll see a rally at some point. At some point here, we're going to see the price go up no matter what happens eventually, right? So if that builds a right shoulder, then maybe what we're looking at is a move down to here. Okay, now that builds. This is the next neckline down here at about 16,000 or just slightly below that. Now when we look at this with a different perspective, what we can start to see is that this is part of a bigger pattern as well too. So looking at this, maybe this is the left shoulder. Here's the head pattern. So if this eventually moves down here, that's the head pattern. And then we would have some type of a rally to build the right shoulder, which is probably going to take at least a couple of months based on this last one down here. Now the target for this is going to be somewhere in excess of 2,000 points below that. So this could lead somewhere down to maybe 14,000 or so. So you can kind of see this, how these fractal patterns create these patterns, the smaller time frame patterns within the larger time frame patterns as well too. Now think about this for a second. I'm not saying whether or not that's going to come true or not. It's just a potential theory based on pattern recognition. But think about how difficult this is going to be on the average investor, right? So if we come down here maybe to 17,000, maybe that occurs starting today or maybe in the next few days. And then we have a violent rally. Most people are going to be complacent about that and saying, well, okay, they bought the dip again. And people are going to, be their usual bullish selves again and just assume that everything is good again. And then if that sets up the right shoulder, there's going to be just extreme confusion as the price fails at that point. Again, they're not going to understand how to deal with that. And then, of course, if that actually releases all the way down to 16,000, people are going to lose their minds because we haven't seen a full 10% correction in a long time. People don't know what that feels like anymore. It has been a long, long time since we have had anything resembling that. Actually, 4 years now, which is a lifetime when it comes to markets. Okay, so if that comes to pass at some point here, once that target is hit about right around 16,000 or so, we should have some kind of outsized rally. This is one of these face-ripping rallies that occurs during a corrective pattern. If you doubt that, go back to 2008 and look at some of the rallies that we had during 2008. And one thing that you'll notice is that if you study price action during bear markets, the majority of the candles are actually still green. They're actually still positive. It's just that when the red ones show up, they're very, very damaging. So think about this seesaw of emotions if we have a rally from 16,000, which eventually ends up building that larger right shoulder and then comes screaming down again. People are going to be just exhausted, and this is what happens during bear markets or corrective action, is that you can't seem to get your feet underneath you because one day it's going up, the other day it's going down. You can't figure out what's going on. The majority of investors walk away from the market just completely frustrated. This is why bear markets or corrective price action is very non-linear, very, very difficult to trade when you compare this versus bull market action, especially quiet and trending, where it's just Groundhog Day, day after day, where it just sort of continues to go higher and everybody's happy. Bull markets like that make everybody into a genius. Bear markets like that, like what we potentially might see, will make fools of just about everybody on here. So it's extremely important that you have some type of hypothesis about how price could act going forward, not necessarily predicting the future, but what you're doing is you're counting for whether price goes up, down, or sideways. So you're never surprised based on what happens. And that's it for today's Market Minute. Thanks for listening, folks. We'll see you tomorrow.